The bank's role in trade finance has changed in the last 2 years due to Basel III requirements. The gap has been filled to some extent by development finance institutions and regional banks.
We're seeing alternative credit providers coming into the market, and these are typically European family offices looking for investments in alternative asset classes that would offer them a yield that has a relatively short tenor to get a return on their investment, and then which is self-liquidating.
On the mining finance side, the continental landscape has changed significantly since 2015.
We've seen a large number of the international banks shut down or pull out or move away from particularly single project financings in Africa. We've also seen some of the development finance institutions pull out of extractive industries. What that's meant is that the number of mining literate banks who can really assess the risk of a new mining project is fairly limited. Most of them, interestingly, for Africa, are based out of South Africa.
Looking at the physical nature and structure of the value chain, that's remained unchanged.
I think what has changed is the way that people look at the risk in the various stages of the value chain, and then also taking a closer look at who is in control of those risks and how can we leverage off the experience, leverage off the potential balance sheet of a buyer of that commodity coming out of the ground to support the actual miner, as opposed to just looking at the miner in isolation.
While banks are a little shy about getting involved in commodities at the start of a project, it's created an opportunity.
There have also been the introduction of a number of resource lending funds, particularly out of North America, looking at funding mining projects and competing with the banks.
The lack of infrastructure on the continent is a well-known fact, but it does seem that the finance people are finding ways to make things work. I'm Angelo Coppola for CGTN in Johannesburg, South Africa.